Are you tired of being denied loans, facing high interest rates, or struggling to rent an apartment? Chances are, your credit score might be holding you back. And when it comes to credit scores, one of the three major credit bureaus you absolutely need to pay attention to is Equifax. So, the big question is, how can you actually improve your Equifax credit score? That's exactly what we're diving into today. Now, before we jump into the specifics, let's quickly recap what a credit score actually is. It's essentially a three-digit number that represents your creditworthiness, how likely you are to repay borrowed money. Lenders, landlords, and even some employers use this score to assess the risk of doing business with you. A higher score means you're seen as a reliable borrower, opening doors to better financial opportunities. Equifax, along with Experian and TransUnion, are the three major credit reporting agencies that compile and maintain your credit history. Each bureau uses its own scoring model, so your scores might vary slightly between them. However, they all generally consider similar factors. So, what are these crucial factors that influence your Equifax score, and more importantly, how can you improve them? Let's break it down. First up, payment history. This is arguably the most significant factor, making up a substantial portion of your score. It simply means paying your bills on time, every time. Late payments, even by a few days, can negatively impact your score. This includes credit card bills, loans, mortgages, and even utility bills in some cases. To improve your payment history, set up automatic payments or reminders for all your bills. This ensures you never miss a due date. If you've had past late payments, focus on consistently making on-time payments going forward. The impact of past mistakes will lessen over time as you build a positive payment history. Next, we have credit utilization. This refers to the amount of credit you're using compared to your total available credit. It's expressed as a percentage. For example, if you have a credit card with a $1,000 limit and you've charged $300, your credit utilization is 30%. Experts generally recommend keeping your credit utilization below 30% and ideally even lower, around 10%. High credit utilization can signal to lenders that you're overextended and struggling to manage your debt. To improve your credit utilization, pay down your credit card balances as much as possible. Even making extra payments throughout the month can make a big difference. If you have multiple credit cards, consider focusing on paying down the balances on the cards with the highest utilization rates first. Third on our list is length of credit history. This factor considers how long you've been using credit. A longer credit history generally demonstrates stability and responsible credit management. Unfortunately, you can't magically make your credit history longer overnight. However, you can avoid closing old credit accounts, even if you don't use them regularly. The age of your oldest account, the age of your newest account, and the average age of all your accounts are all considered. Closing older accounts can shorten your average credit history and potentially lower your score. Fourth, we have new credit. This refers to recently opened credit accounts. Opening multiple accounts in a short period can raise red flags for lenders, suggesting you might be taking on too much debt. To improve this aspect, avoid applying for multiple credit accounts at once. If you need a new credit card or loan, space out your applications by several months. This demonstrates responsible credit-seeking behavior. Finally, we have credit mix. This refers to the variety of credit accounts you have, such as credit cards, installment loans, like car loans or mortgages, and lines of credit. Having a mix of different credit types can positively impact your score, showing you can manage various forms of credit responsibly. If you only have credit cards, consider taking out a small installment loan and making timely payments. However, don't take on debt just to improve your credit mix. Only do so if you genuinely need the loan and can comfortably afford the payments. Now, let's talk about some specific actions you can take to directly improve your Equifax score. First, get a copy of your Equifax credit report. You can obtain a free copy annually at annualcreditreport.com. Review it carefully for any errors or inaccuracies. Mistakes like incorrect personal information, accounts that don't belong to you, or inaccurate payment history can negatively impact your score. If you find any errors, dispute them with Equifax. You can usually do this online, by mail, or by phone. Provide supporting documentation to back up your claim. Equifax is required to investigate and correct any verified errors. Another important step is to become an authorized user on a responsible person's credit card. This can help you build positive credit history, especially if you have a limited credit history or are just starting out. Make sure the primary cardholder has a long credit history and a good payment record. It's also crucial to avoid maxing out your credit cards. As we discussed earlier, high credit utilization can hurt your score. Keep your balances low and aim to pay them off in full each month if possible. Be wary of credit repair scams. There are companies that promise to magically erase your bad credit for a fee. These promises are often too good to be true. There's no quick fix for bad credit. It takes time and consistent responsible credit management. Focus on the strategies we've discussed today, and you'll see gradual improvements over time. Also, be patient. Improving your credit score doesn't happen overnight. It's a gradual process that requires consistent effort and responsible financial habits. Stick to the strategies we've discussed, and you'll see positive results over time. Remember, building a strong credit score is an investment in your financial future. It opens doors to better interest rates on loans, easier approvals for mortgages and rentals, and even better job opportunities in some cases. By understanding the factors that influence your Equifax score and taking proactive steps to improve it, you're setting yourself up for greater financial success. With that said, thanks for watching, and until next time.